Okay.
So here I am with Ruben, and it's Bruce again, and it is August 31st. And we were just commiserating with each other. Ruben has just returned to Canada from Costa Rica, and I've just returned from Curacao. And we were commiserating with each other how difficult international travel has become.
Okay. Well,
so now what are we going to deal with?
Right. So we're gonna talk about what we're gonna do the next step on the self-storage expansion and the ideas. But before, just a couple of news, I would say. The offer for the building 747 Indian Road 22 unit was accepted, and at 3.8 million.
You got to be kidding me.
It is. They are. It was accepted on Friday. Actually, I had to do it from Costa Rica because I had no choice, and we went back and forth a couple of times, and that's where we landed. I think that is a fantastic deal, and it's closing the end of October, kind of beginning of November. And this is a big company. This is not an individual. Is the company's Regent Properties. They already have a few hundred of these things. So, and the second,
just before we go on from that, I think you bought it for in the ones. Am I right?
1.4.
Yeah,
actually was 1.350 because they gave us a discount for the roof. So yes.
What year was that?
Was in September of 2016. Okay. So if you calculate the increase in price is way beyond that, something that can not even close that we could reach that number. And in Sarnia, some things like that can happen in here in Vancouver, Toronto, but not in Sarnia, right? But it is happening in Sarnia.
So let's just for the heck of it, so we know, let's just look at the number, okay? Because this is important for you to know for the future, okay? So give me the address again, 727?
747 Indian Road. But
I should remember that because 747 is a big number.
But I would like to spend some time more on the project.
No, I understand that we will, but this is important for you. And if we spend it, we'll spend 5 minutes on it, or not even.
Okay.
Just bear with me, okay? So we'll go 2016. It was purchased for 1,300,000. Oops, should be a dollar sign. Just you'll see what I'm doing. It's very quick. And 2021, it was sold. So this is bought. Oh, come on, fire rocks. And 3.8 million, that's an incredible deal. I'm blown away.
Yeah.
So, okay. So what's your guess as to what the compound percentage is? What's your guess?
The compound percentage per year?
Yeah.
I came about 40, about 45, I think.
I don't think it's that high. Let's try 20%. All right, just see what we'll say. We'll say annual compound increase. All right, compound. So let's guess. All right. Now the way to test that is you take this number, your original purchase price, and you multiply it by 1 plus this interest rate. And you see the little hat, that means exponent. And the exponent is this year minus this year, in other words, power of 5, right? So 20% would give you 3.59 million. So it's higher than that. 22% gives you almost what you're looking at. So the answer is 23% per annum. That's your compound interest rate. Okay.
Compound increase in price or compound
exactly. You made, did you make any cash on it as well? I mean, did you have cash flow while you owned it?
Oh yeah. I mean, this building has been cash flowing. Even was able to pay 5% on a line of credit that Faye plays for about 3.5 years until we refinanced in 2019, and we gave her back 100% of the money.
This is incredible. All right, so I'm gonna call it 747 Indian Road. Oh shit, Bruce. And I'll send you the spreadsheet so you have it. All right, so that is a fantastic, unbelievable success.
It is.
So plus, I'm going to go in caps, plus Ruben et al. Made monthly cash flow, right? Plus Ruben et al. Made money from mortgage pay down by tenants, right? They were paying down your mortgage for you.
Yeah.
So this is fantastic. I mean, so I just wanted to say that what you're doing, okay, I'll save that. Let me just stop sharing now. So just to be clear, I'm a buy and hold guy, and so are you. However, recently I've come to the conclusion that when you're seeing those kinds of increases, you should sell it. And the reason for that is that if you can invest in properties that have the ability to have more appreciation, maybe you're at the top of the market here with that thing. If you can invest in things that have higher cap rates and have more room for growth, you should do that. So what I did this year was I went through my portfolio, Ruben, and I identified things that I think had matured and we're not producing the same kind of value increases, and we're not providing the same amount of cash flow or the same high cap rate that I'm getting on some other properties, and yet their prices had gone stupidly up. I sold them to redeploy it.
Well, I think we already now considering, because Tom, our realtor, he has a client, so we are considering to sell the fiveplex. Because the fiveplex is as well. I mean, it has increased not as much as this one, but at least double in price, maybe more, right? So, and people are willing to pay that, right? So, because we want to deploy that either to the sixplex, to the new sixplex, or to the self-storage project that we want to discuss, right?
Yeah, I'm just adding some stuff here for you. All right. Okay, so we're good. What was the second point?
The second point is that the offer for the Petrolia self-storage was accepted yesterday at $950. And I know when I show you the numbers, I know that the cap rate is shrinking, but as we have spoken before, we want to get this different facilities across Canada. In this case, it happened to be in Petrolia. Petrolia is very close to Sarnia. Is very close to Wyoming, right? So it's in the vicinity. And I went to see the facility from the outside. I didn't get in it. So it's kind of it's been in a family for many years, and he wanted, and I know it's not the price or the cap rate that we got in Wyoming, but that's what I mentioned to you when I combine it with Champlain, right? And I put the numbers together, which is the tables that I send you. And this is only a draft at this moment, right? We got to go to a couple of iterations on that. But when I put Champlain and at the same time add two buildings in Champlain, and actually looking at it, it doesn't even matter if we add it in Petrolia or if we add it in Champlain. The two buildings will rent at about the same price, right? So the two buildings actually made the difference. I was running around the numbers and it didn't work. It didn't work. I said, well, like we talked before, why don't we capture all of this capital at once? We expand Champlain, but we purchase Petrolia with the same amount of money, right? That is coming into this pool. So that's where this idea came to say, okay, well, we capture it at once instead of buying Petrolia and then trying to, okay, put it together with Champlain or trying to expand like we've been doing before, right? If we buy Petrolia with, I'll give you the address of that place so you can see it, right? So that's where. So the distance between these two places is about 10 minutes.
It shows, according to Google, it shows 8 to 10 minutes.
Yeah. So we drove it. I mean, I know this area very well, right? And
what's the address?
Let me see the exact address in here. Well, you are. The address of that is.
Is it called Access Mini Storage?
It's called Ultimate. Access is the competition.
Okay, I'm looking for it. I don't think they've registered it on Google Maps. I put mini storage in Petrolia, and the only one that comes up is Access.
Let me just give it to you here. Let me just. It's 4493 Progress Drive. Where am I? So, where am I? Oh, here.
So here is the competition, Access.
Yes.
Up here, and then here is this guy. So I'm going to just get directions to Access. So it's about 4 minutes away from Access. Here's Access, and here's Progress.
Yes.
All right. Okay.
So you can, if you click on the Google Earth right there at the bottom, you can see it from the air, from up.
And how big is the site again?
It's about 2. I gotta get the exact measures. The thing is, if you see on the back and on the side, there is room for expansion. Yeah, you can measure there. Will be. Let me see how.
So this, according to Google, is about 78,000 square feet. So it looks like just under 2 acres.
Yes, yes. So that gives us a chance to expand at least a couple of more buildings in there, and one building on the side. He has a few couple of RVs parked in there. He owns that bus depot on the side.
Over here?
Yes, he's the owner of that site. So
did you ask for an option to buy that, or did you ask for a right first option if he sells it?
No, actually, no. Just
that's okay. I'm just asking.
Thinking about that, yeah. But that's him, right? He owns that portion in there. They do.
It's called Hull Bus Lines.
Yeah. Mm-hmm.
So one of the things that you might do, Ruben, is, do you know what the difference between a first option and a first right of refusal?
I know the first right of refusal is the one that, when somebody wants to buy and the other one doesn't want to sell, right? So, but if you can expand that to me.
Okay. So a first right of refusal would mean that if somebody makes an offer on the neighboring property, you have the right to match it within a certain period of time.
Mm-hmm.
Most sellers will not agree to that, because it means that if they, let's say I wanted to buy, this property next door, and I come to, what's the guy's name?
Steve
I
Hall.
come to Steve and I say, Steve, I'd like to buy this property from you. And he says, yeah, listen, give me $1 million, you can have it. I say, okay. But he says, I got to go back to Ruben, and if Ruben wants it for $1 million, he gets to buy it. And I said, well, I would say to Steve, well, Steve, I'm not going to be a stalking horse for Ruben Ugarte. If you talk to Ruben, if he wants it, he can have it. But if he doesn't want it, then let me know. So a first right of refusal kind of puts the seller in handcuffs. Okay. A first option is different. So what I would ask Steve is for a first option on the neighboring property. And that is, if he ever decides to sell it, he comes to you first. And he says, Ruben, I'm going to sell this property for $1 million. Do you want it? And you say, oh, gee, I don't think so right now, Steve. That means he can go out and sell it to anybody he wants for $1 million or more. However, if somebody comes along and offers him less than $1 million, say they offer $900,000, he has to come back to you again and say, Ruben, I've got offered $900,000. I think I'm going to accept it. Do you want it at $900,000? So it's a little bit different, but it gives the seller the absolute right to sell it, but it also gives you the right to buy it. In other words, you get the first option, and if he sells it for that price he offered or more, he can sell it all the live long day. But if it's for less, then you get another crack at it. That works for both seller and buyer.
How do you how do you do that? You sign an agreement separate from the purchase agreement of this one?
No, you're in real estate. You're supposed to have one agreement, not 10 agreements or two. It's actually illegal. You know what people used to do, Ruben, is let's say I was going to buy a property from you. So back in the day, it was legal to do it. I would say, listen, Ruben, I'm going to buy this property from you. Instead of paying you $1 million, I'm going to pay you $1.4 million. You go, oh, this is great. I'm going to get $400,000 more than I'm asking for. But then we would sign a separate agreement, which would say, Bruce is going to do some consulting for Ruben over the next 5 years, and you're going to pay me $400,000. So you get your $1 million. But for me, as the buyer, I can go to the bank and say, look, I bought this site for $1.4 million. I can get a mortgage that's, the full $1 million, basically. So I can do no money down transactions. Ontario made that illegal. All right. Mm-hmm. So what you might do is you might say to Steve, look, Steve, I talked to my coach the other day. When are you going to close this deal?
I added, it's about 90 days. Okay. I haven't worked out all the dates yet, but it's gonna be just before the end of November.
Yeah, that's fine. So a 90-day closing, which is fine. But sometime between now and November, you say, look, I talked to my coach, and I'd like to have a first option on the land next door if you ever decide to sell it. And you have to tell them right away, it's not a right of first refusal. It's not that. It's just that I want you to and your lawyer can do this, all right? Your lawyer can include it. You don't have to use a realtor. You don't have to do anything. The two lawyers, as you know, can agree to something just by trading emails.
Yeah.
Realtors can't do that. Everything has to be ready for a darn realtor. But your lawyer, your real estate lawyer, who are you going to use on this transaction?
I've been using in that neighborhood. I've been using Martin. Is a lawyer in Sarnia. So
you could use Steve Shepard if you want to. He closes transactions for me and my clients all over Ontario. But you decide who's best for you. But make sure your lawyer understands, because if your lawyer screws it up, make sure he understands the difference between some lawyers. They forget stuff, or they don't know stuff that they probably should know. So make sure you explain to your lawyer, whoever it is, whether it's Steve Shepard or your man in Sarnia, that first option here is different than a first right of refusal, and you can explain it to him. And you say, Steve, look, I'd like to have, it just means, Steve, if you decide to sell it at some point, you come to me first and say, look, I'm going to sell it. I'm going to ask $1 million or $1.5 million, and he gives you the option to buy it. If you say no, he goes off and sells it to whomever he wants for the $1 million or $1.5 million or whatever he's asking. Okay, so most sellers would say, oh yeah, that's fine, and they say you don't even have to put it in writing. I would do that anyway. So if it was me, if I owned the bus and I was going to put it up for sale, who's the first person I would talk to? It's the guy who bought the property next door. So it's really just confirming in writing, though, that what he would do, a sensible person would do anyway.
Yeah. Okay. Okay. Got it. Okay. Okay. So this is what it is now. If we just purchase that property and mostly looking from the point of view of what kind of offering are we going to make to investors, right?
Yep.
And going back to the core idea that RMDR Storage, which is the the owner on Champlain,
yep,
will be 100% shareholder on the new corporation that is going to own Petroleum. The reason for that, and it comes from our accountant, right? Is because he was explaining to me that it's better. I mean, we can purchase Petroleum with RMDR Storage, but we may not want to do that. I mean, it's something that we can decide in here. It's just a legal structure, but it also creates another company that I have to do maintenance and all of that, right? I mean, but it will be separate transactions. However, for the purpose of presenting it to the investors, I would like to present it as a one project, right? Where
to my way of thinking, Ruben, sorry to interrupt you. To my way of thinking, I do, I believe in keeping things simple. And having yet another company to do financial statements for, and income tax returns for, and HST returns for, et cetera. If it was up to me, and listen, I don't want to contradict your accountant. You should follow your accountant before you follow your coach, because like I said many times, I'm just a lowly engineer. But for me, I would use RMDR to acquire Petroleum directly. I would just have one company, and I would own Champlain and Petroleum one company. I just the extra step. I just don't think it's necessary. But that's just my.
Okay. I'm with you. I'm not. I'm in here. I'm kind of neutral. We did it with Solalma. If you see Solalma, Solalma owns 3 properties, right? So we just, and probably now we're gonna have to decide what to do with the profits that are gonna come into Solalma after the sale, right?
Oh my gosh, as you know, we've talked about that. The profits are unbelievable, but I don't think you want to take your existing partner into anything else. Like she is going to make out. I bet you her return on investment is like 500%.
No, it's infinite. But that is something that we're gonna have to discuss. I would say separately. Just to know that, because I have calculated so far that Solalma is gonna end up with about 1.4 million cash in the bank after taxes.
Wow.
After taxes and expenses.
Incredible.
That's what is going to end up in the bank like that. And so since that amount, we have to decide. I still, and I know what you're saying, I still want to offer Solalma to invest in RMDR Storage as an investor, right?
Yeah.
Now, but I know what you're saying, right?
Because here's what I think is going to happen is she's going to look at this new deal and say it's not as good as the old deal. Well, there's no deal that I've ever seen, an infinite return investment.
Yeah.
Holy smokes.
No, I know, but what happened is, I would say, just for the sake of, I don't know how you call it, right? Going to your first investor.
Oh yeah,
but
I get that.
No. Remember that we've been talking about. just doing this brief thing on Solalma. We've been talking also that Solalma can lend money to RMDR Storage,
exactly.
Right? I don't want to penalize RMDR storage at this moment because I'm going to run through the numbers now because I want to. Okay, so are we? I mean, the thing on buying RMD, what do you call it? Buying Petrolia with RMDR storage, for me is not. I mean, I'm neutral on that. I mean, it might be, and I'm with you. It is a lot easier to do one accounting, one QuickBooks. Yep. I mean, with two accounts actually. That's how I've been doing it in Solana, right? I created 3 bank accounts. We kept the money separate in QuickBooks. Even I created separate accounts, right? So I think that's. I mean, that's irrelevant at this moment. I can assign the deal in Petrolia to any company that I want. At the moment, I have it under RMDR Global because I placed all my offers under RMDR Global, right? But yeah, okay. So let me share the screen, because this is where I need the coaching part.
No problem.
I'm gonna share the Excel sheet because it's easier if I do the Excel sheet.
Yeah, that's fine.
Okay, let me walk you through it. You have it in PDF, but let me walk you through it how this software thing works in here, right? This is the way I did it, and it took me, actually the alignment came in Costa Rica, right? How to put this thing together, and this is what I did. It says, okay, we bought Champlain for 415, but on top of that, we placed 175 to make it round numbers, and it was a loan, right? It was a loan from RMDR Global. So I said, okay, then the deal actually is worth 590, right? Without going into the thing on Champlain, I said, well, let's assume that we are buying Champlain at 590, right? And now we are buying Petrolia 950. So I'm trying to make it, like you say, simple, but saying, hey, these are the two properties that we're gonna put together, right? Doesn't matter what we have done in Champlain. Champlain is already producing money, right? So it's not coming from zero. So that's what it can. So I say, well, we are buying a project for 1.54 million.
Yep.
Right, and correct me if I'm wrong in the way of the analysis or in the thinking, right? But then I said, okay, well, in order for this thing to work, I need to put 2 buildings, minimum 2 buildings, anywhere, either in Petrolia or in Champlain. They're about the same pricing. We actually charge a little bit higher in Champlain than in Wyoming, right? So Champlain might be the best location to put 2 buildings, or 1 single building, right? We don't have to put 2 buildings, right? We can put 1 single building, right? But work around 8,000 square feet.
Or you could put 1 in each place.
Or we can put 1 in each place, but work around 8,000 square feet. So it's more on size, independent on what type of building is. But say work on 8,000 square feet will cost around 400,000, right? Give or take, right? And then they say, okay, so we're gonna do closing costs. Well, I put closing costs only in Petrolia because the closing costs already are in the 590, right? That we did in Champlain. We're gonna put land transfer costs only in Petrolia because that's land transfer tax already is in 175, right? And then the 2% finder's fee, and this is a finder's fee in Petrolia, and this is for RMDR Global, right? Okay. So that's how it works. So it came out to be about 2 million. Then the program here asked me to say, what is the cap rate that you actually want to operate this project at? And I said, well, let's do it at 6%, right? I know it might operate a little bit higher, but 6%.
6 is the minimum.
6 is and it's a kind of an attractive rate for when the investors see this. Okay, this is how we had to structure the deal. This number here is already the Westboro mortgage, right? So we got this mortgage, right? This is what I'm estimating that I can get as a mortgage in Petrolia. Give or take. It's just, the banks and the lenders are not, too keen on more than 65%, right? So that's,
Yep.
and this is what the thing is, right? With your idea says, I'm gonna place half of the money, okay, because, okay, let's go back. We need 900, and I rounded off to make it very easy. We need 900,000 to purchase Petrolia and to put the two buildings, right? And all those expenses, 900. I said, okay, so like you suggested, let's split 50%. Yes, good.
Sorry, I did interrupt you, but the mortgage you're putting on Petrolia is going to be 570, and the loan from the investors is 625, right?
Well, no, it's a combined loan. Because,
oh yeah, so where's the $1 million? I only see 625.
okay, I'll get there. So 625, you subtract 175, which is already is a loan already in Champlain, right? From RMDR.
Right.
So you end up with 450 here.
Okay.
From the investors, right?
Right.
Now this loan here overall is at 5%, right? It's not an 8%. It's not a hard money lender, right? Because this is investors' money, right?
Right.
And 450 here makes the 900 from the investors.
Right. Okay. All right.
So 450 is equity purchase, right? And 450 is a loan combined with 175 from RMDR.
And for the 450,000 in equity, how much of the business do they own?
I calculated, I can play with that, but I can show you that. I calculated 35%.
Okay, that was my number too.
Right. So I'll show you that screen in a minute. So this is the premise how we structure the deal, right? So we get 900, right? We put it, part in Champlain. We purchase Petrolia. We operate Petrolia. We can operate Petrolia as is, and it will be cash flow positive, just Petrolia, but very, very small, right? Champlain is the kicker, right? Champlain is the one that actually will support the project, but it makes it attractive for the investors now to say, okay, now you got 100 plus units in Champlain, 70 units in Petrolia as one company, right, that they own. And then if another deal comes its way, then we can go and do another capital raise, right? Another issuing of shares and all of that, right? Right. Is that right? I mean, I'm on the right track with that.
If you're giving up 35% equity in this deal, and you do another raise and you give up another 35%, that's not a good thing for you and Mary Lou.
But that's my only thing on how you do a second raise.
So because one of the things that I would probably do, this would be my advice to you on this one, is I would put more of the money, raise more of the money as debt and less as equity. So instead of having to give up 35% of the company, you could give up less than 35%. So instead of having $425,000 or $450,000, whatever it is, 450, I think, as debt and 450 as equity, maybe you only take 150,000 as equity and you take 750,000 as debt.
Okay, let's do it right now.
If you did that, instead of giving up 35% for 450, you'd give up about 10% for 150. And that means in your second raise, if the business continues to be successful, your second raise, maybe you only have to give up 5, 6, 7, 8% of the equity. So now you've only given up 20% maybe, or 18%. Then you could do a third raise. And by the time you get to the third raise, your equity presumably is going to be even more expensive to buy, which is good for you. So at the end of the day, you've given up 35% of the equity, but instead of raising $450,000 or $900,000, you've raised, $4 or $5 million.
So how do you think this guy? I mean, maybe there are different type of investors, but
for me, what I would do, Ruben, the change that I would make to it is I would offer investors 8% on their debt. not 5%. And I want to listen. This just again, this is what I would do for myself. But what you would do to lessen the cash flow implications of that is you would offer them 8% for 5 years, but it's capitalized and paid out at the end of the 5-year term. So they're getting 8% on their debt, and they're owning 10% of the business.
Capitalize at the end.
Yeah, so it just means that you don't pay it every month or every year. You just pay it at the end. So let's say you raise $750,000 in debt. 8% interest is about 60 grand. At the end of 5 years, you'd owe $300,000 of interest. And by the way, I always, when I put 8% in there, I make it simple interest, not compound interest.
Yeah, interest only, we can call it, right?
Well, interest only, but it's not compound, because compound can run away on you, as you know.
Yes.
So what I would offer, this is just what I've had a lot of success with it in Canada and the United States. Investors love 8% returns. I mean, you know, we've talked about it a million times. My NHL locked-in retirement account, maybe it made 1 or 2% over 25 or 30 years. It never made more than, I think, 2 or 3% in any year, and lost money many years too. So if you give somebody 8% on their money, even if it's only simple interest and it's capitalized to the end of the term, that's an attractive number. And then they get a bonus, basically 10% ownership in the company.
Okay, this is where the problem comes in. This is where the problem comes in with that interest rate. See, I just did the change. Okay.
Yeah.
I just put.
But you've got to remember, there's no interest payable for 5 years.
No, I know, but the program is calculating the cash flow anyway, right? I know it's not. Actually, I can come in with
you know. I don't agree on this, okay? So I'm going to stand up for this. You and I have been like this on this, okay? So I just want to just reinforce something, okay? The beautiful thing about capitalizing the interest for 5 years is that you are never going to pay it from cash flow, ever. What you're going to do is you and Mary Lou are going to own Champlain and Petroleum, maybe a bunch of others, but right now, if it was just Champlain and Petroleum, 5 years from now, what will they be worth? They'll be worth, I mean, if they follow Indian Road, they'd be worth a hell of a lot. But let's just say that it's less than Indian Road. Let's say that instead of being worth, you know, $2 or $3 million, they, you know, you and I've talked about Champlain. It has great potential. Let's say it's worth, the two of them are worth $6 million. What you're going to do in 5 years is you're going to refinance the business, and you're going to pay that $300,000 of interest from the refinancing. It's not from the cash flow.
I see. I get confused with that.
I don't like this model, and you know, I want to be polite, of course. I know you like this model, but the thing about real estate that is really very special is that as long as you're investing, and you and Mary Lou are investing in high cap rate properties that cash flow, you are never, ever going to have to pay a dime of the interest. It will be paid by the refinancing, and you'll take the capital out of the business because it'll be worth $6 million, at least, in my opinion, in 5 years. Okay,
you just clarified a big doubt that I had on this model. No, I agree. I can put my little formulas in here. I just want to show you, okay?
All right, do it, but you should do it. And I think what you're going to find is that, you know, I looked at this model. I mean, I did read it before you and I started. And I think that the equity buildup that you're showing in these two properties is much too low. And I wouldn't show that to investors because I have confidence in you and Mary Lou. Look, you bought Champlain when nobody else would buy it. You know how many people I talked to about Champlain? Even the original owner, or not the original owner, the second or third owner, you know, who got money from the same company you got and then paid off his credit cards or his wife's credit cards with it, which was a terrible thing to do. Do you think he could have done with the $200,000 or $300,000 he borrowed from, what is it called? What do they call it?
Westboro?
Westboro, yeah. You know, he borrowed $300,000 and he paid off his wife's credit cards with it instead of putting in the business. This should have been his business, you know, and he's a nice man, but that was not a good thing to do. You know, so it's like eating your seed corn, right? If you know, if you and I were farmers in Honduras and we decide this year we want to get big and fat, we eat our seed corn. What do we do next year?
Okay, so let me see, because I need to prepare the tables, and I can do it in here through this system.
I'll trust you.
I just have to kind of forge it a little bit, but okay, let's look at this thing.
Okay, let's do it.
So we have, I mean, the program is calculating 6,167 interest monthly, right?
Yeah.
If we're gonna be paying it monthly, what I can do is I can get this number, multiply by 12, subtract it in every year, right?
Yeah.
And see where the equity comes out. Right. But this is what it is. If I go to the cash flow analysis, okay. Well, let me just quickly here show you the income and where this thing is coming, because that's important, right?
Yes.
This income here is real right now, right?
Yeah.
This three buildings. I mean the buildings. The parking spaces is coming there. We're gonna get a few containers from Greg, and we are finishing the RV parking. By the way, I will show you pictures. It's beautiful.
I can't wait to see it. Come on, show me the pictures.
Let me see if I have the pictures.
I really enjoy it.
Let me see. Where are they gonna be? They're gonna be in the email from Jeanette. Where are Jeanette? 1 minute here. I think we got a couple of pictures in here. It's not complete, but I don't know. Are we sharing here? No.
No, I'm still seeing the spreadsheet.
Okay, let me share again.
Yeah.
Pictures in here. Let's see. I got a couple of pictures.
Oh, this is cool. Okay.
Look at
that. Wow. That really looks sharp.
Look at that.
Oh my gosh, that is really nice. He did a beautiful job.
He hasn't sent me the index, by the way. So
it looks like he compacted it too.
Oh, we went because I that's what the purpose of the trip. We went down 10 inches.
Wow.
He put all the material from a vacuum that he took out of the other buildings.
I remember that, yeah.
And then he put this gravel, and then he compacted it. So we got
fantastic.
I think we got a couple of more pictures. Let me see.
That is really great. Man, what a change you guys have made out there. It's fantastic.
I will we're here. No, I think I have it on my phone. No, I will prepare for you, but
send me the pictures, but that looks fantastic.
Yeah.
There's nothing like gravel to clean up a site, you know.
It is great. So
it is great. Oh my gosh. I'm excited for you. And,
so
one of the things you're going to do, Ruben, I'm going to hold you to it, at least I'll try to, is one of your buildings is going to have those storage and mini workshops in it.
Yes, I agree with that. The only thing that I need to find out and clarify if that zoning that we have right now will allow that inside the fence, because what I'm trying to do, remember that I'm trying to get no zoning change for this expansion.
I get it. But hang on a second. When you only have 2 acres at Petrolia, right? A little less than 2 acres, or about 2 acres, you want to add, when you add a building there, you want to add the highest value added building you could possibly add. And I just rented another one of my workshops. I built another workshop because I love them. You know, I wish I had 1,000 of them. But anyway, I just put another workshop together. It's only 200 square feet, and it comes with a storage container. I rented it for $500 a month. You know, that's pretty good. You know, it's a 10 by 20 with a bit of storage inside, and I got $495 a month.
Great. No, I totally agree with that.
You know?
I just like if we're gonna do it in in Champlain.
Oh, you definitely should do one in Champlain, but definitely if you could build 2 or 3 buildings, but start with one. Make sure it works for you. Like it works for me, works for my friends in Waterloo, works in Kitchener, works in Long Beach, California. It's going to work in Wyoming. It's going to work in Petrolia. It's going to work in Champlain, but you should test it first, right? So you just build one.
Yes.
And make sure
That's
you and
right.
Mary Lou are comfortable with the model. But once you get the taste of it, and don't forget, when somebody has a storage and a workshop, the storage is a cost and the workshop is, storage is a liability and the workshop is an asset because you can make money there. You have a little office in there and you have your, it's a workshop. You can build stuff, make stuff, do stuff in there. Once you have the asset, the liability and the asset connected like this, people stay for a long time. Like my workshops, I haven't had any vacated, and I've been at it now with Aikens Road and a couple other properties of my own. I've been at it for like 5 or 6 years.
Right, right.
And all they do, so far, the only thing that people have done is grow, and take more space, which is kind of cool too. So on this model, we've talked about what differentiates extra storage from a million other storage places out there. This is one of the keys, in my opinion, to the future. I'm looking to buy another building. I'm going to Belleville on Saturday. I'm going to try and buy another building, an industrial building in Belleville. And it's got about, it's not as big as Petrolia, it's only got about 1.5 acres. And we're going to turn the building, it's about a 4,500 square foot building. We're going to turn that into probably 15 workshops, and again, it's a substandard industrial building with only I think one, it's kind of got a roof line like that. Over here at the front, it's only got like 9-foot ceiling height, and then in the middle, it's got probably 13 or 14 feet. So it's been for sale, Ruben, for 500 days. So no industrial company will buy it because you just can't do in big industrial stuff in something that only, at least in part, is 9-foot ceiling height. But many workshops, man, that's so we're going to try and buy that this weekend.
Yeah, good, very good. So I just wanted to show you this part of the income.
Okay, so here's the income.
Yeah, Petrolia is roughly 7,600 a month.
Yeah.
So I still have to confirm everything in Petrolia. I don't, I'm getting, he uses the same software that we use. So I think it's going to be easier. In the new buildings, I'm calculating about 3,400 a month on those 2 buildings, right?
So can you try this model? Try it with 1 building in each location being micro workshops. You should try it, see what happens to your income, and it'll be more expensive to build because it has to be insulated and heated. You don't need
that we have a problem in Champlain because the distance, the distance, as is pretty far in order to use gas, because that has to be with gas, not.
Oh, you don't definitely don't use electric baseboards in Ontario.
Yeah, so it has to be gas. I will have to the investment will be much bigger than 400,000. I mean, if we're gonna do
I just want to raise the possibility, though, for you that places like Petrolia, Sarnia, Wyoming, Champlain. There's you remember we talked about it before. The variable I look at is the number of pickup trucks sold as a percentage of overall vehicle sales. And I'll bet you if you get the stats for Champlain, Wyoming, or Petrolia, it'll be pretty high.
Yeah.
I've got people in Saskatoon doing it. I've got people in Edmonton doing it. And I think there are more pickup trucks in Edmonton than there are people.
Yeah. So I think, and that would be part of my research now, which starts this week. I think that building is more adaptable in Petrolia. Because Petrolia is right on the street, right? And I bet the gas line is right there, right?
That's a good point. Can you check if there's natural gas in front of Petrolia?
Yes. Yeah, we'll do that.
But don't check that with the seller.
No, I will do everything on my side.
Independently, because I don't want anybody but you in this industry to be on this bandwagon of mine. Okay.
Mhm.
So I don't want to clue in your neighbors or your potential competitors before you've even bought it, right? This is your intellectual property. I want you to take advantage of it.
Yes, yes. So the way I see it, and it's because of distances, right? And because of geographic location, as you saw in Petrolia,
Yeah.
the building is right there on the street.
Yep.
But again, I have to check the zoning, right? I need to do all of that homework. All I wanted was this guy to accept the offer. I gave enough time to do all of this homework, which I know what to do now quicker. But my main thing was to put this thing together. So let me just, before we finish, let me just show you something.
Okay.
If I did it that way, right, when we are putting 150,000, right?
Yep.
But I'm gonna have to create a different cash flow here.
Yep.
Because let me just see. If you give me a minute, and here I can do something.
Yeah.
What I'm gonna do is I'm gonna simulate that on the debt service. I'm not going to pay 61,000.
Yeah, 61,000 I think is fair. Minus 61.
Well, maybe it's a little bit more because it's 6,117 is 6,067 times 12.
I think it's 60,000 bucks. 750,000 at 8% is 60,000.
Well, if we include an MDR storage 175, maybe not. But let's do only for the investors.
Yeah, I'm just going to subtract 60.
Okay, so let's do 61,000. Okay,
sure.
61,000. Let's just do it because if not, it's difficult to calculate if I don't do this, right?
Yeah.
Oh, so this is wrong. I need to add it.
You have to add it, exactly.
I need to add it.
Yeah.
Right.
Hit enter. There you go.
Okay.
That makes more sense.
I'm just gonna add the 61,000 every year.
Yeah.
Just for 5 years.
Oh,
and
cool. Yeah, for 5 years plus.
This is all I have to do here.
This is cool.
And then we'll see the value also changing.
Interesting. After 5 years, what does it say?
Well, changing the cap rate. Yeah, it will. Where am I here?
Yeah, one more.
One more year.
Yeah,
okay.
Attaboy.
Okay. So the way it works,
wow.
This number here, the 1.672, comes from my inputting of the cap rate, right? I can increase or decrease the cap rate, right?
So for investors and fair market value, I think the cap rate is probably 4.5%, not 6%. For you and me, it's 6% or higher.
Okay, let's do 5% then in here.
All right, let's do 5%.
Let's do 5 here, right?
Okay, that's fair.
Okay, so that definitely will increase the value of the building. Look at this.
Exactly.
Right?
Now that makes more sense now.
Okay, so let's work with this number, 3,085,000. If we come at the end of 5 years and we refinance, we can get about, just talking about the refinancing, 3,085 times 65. So we can get about 2 million. Now the mortgage at that point, which includes both mortgages, and the debt of the investors, is 1.75.
Oh, you're in great shape then.
So we can pay off that loan, that mortgage loan, not the 150,000, and we still have 300,000 extra, about 300,000 extra.
And in my opinion, the $3 million valuation 5 years from now is very conservative.
Right. Okay. So
it wouldn't surprise me if it's 5 million or even 6 million. But let's say it's 5 million. But even if it's 3 million, you're still in great shape.
Yes. So we can. The idea is here that we can pay off, the 300,000. Well, actually, it's more than 400,000, because this number here includes that 400.
Actually 300,000. You take it out and do some more buildings.
Actually, this number includes 700. What was it? 150, 900. Yeah, it includes 750 from the investors here.
Yeah,
Here.
I know that.
Plus the mortgage in Westboro, plus the mortgage in the lender for petroleum.
That's
So
fantastic.
all of this is in here, but it doesn't include the interest that we owe, right? Because we owe 5 years
Yeah.
at 60,000, so we owe 300,000, right?
Correct.
So we can still pay it. I mean, I'm not concerned about that. Like you say, this number might be very, very conservative.
If it's $3 million 5 years from now, you and Mary Lou, would be very disappointed. So would I.
Yeah. Okay. So now when we get the partnership,
it does mean that with conservative assumptions, you're on the right track.
right? So then, if we go here and we get, I can also make it work in here for the investors, right?
Right.
They're gonna put only 150,000, right?
Yeah.
Because the rest is in debt. So here, this module gives me the rate of return of the investor.
And
Look.
what is it now?
Look at this thing.
Wow. Fantastic. Fantastic.
So it is at that number. And actually, no, this is more because this is 35%. So we're saying that we're just gonna sell.
They're only getting 10%. Yeah.
We're just getting 10%. So let me just change this number in
again.
here.
Do it again.
So here is 90%, right?
Yeah, correct.
So here, let's see what they get. Well, it's good. I mean, that was too much. It is here.
That's a very responsible. Like most investors want anywhere internal rate of return anywhere between 18 and 24%. Right.
Well, but they are getting 8 on a portion.
Exactly.
And they are getting this number. Let's say at the end of 5 years is 13, right? 14 for them, right?
Yeah.
Plus on the 150,000,
right? And
8% on the 750.
Yeah, exactly. I mean, it's a fantastic deal for them, and they don't have to sell after 5 years. If they want to sell out, they can sell out. But our MDR is you're not going to only end up after 5 years with two properties, Champlain and Petrolia. You'll end up with probably 5 or 6, or for all I know, 10 or 20.
Right. So then the thing is, now you gave me the thing on. Well, if we're going to be selling equity, every time that we come to sell more equity, our MDR storage share value price, whatever it is, will be higher.
Correct. So your first 10% of equity you sold for $150,000, right? Plus people are putting in some debt. The next 10% you might sell at $300,000, and they put in $750,000 in debt or $1 million in debt. And then the next 10% might be at $500,000, and they put in another $750,000 or $1 million in debt. So this is the way you do it, so that at the end of 5 years, as you expand the business, you buy more of these mini storage places. You and Mary Lou end up owning 65% at the end of 5 years, not 20% or 30%. Because that's very important. Because if you and Mary Lou end up with 35% of this business, it will be very uninteresting to you. I don't like either. I want to own 10% of a business, so I just own a little piece of a business, and you hope it does well. If it does well, it's gravy. If it doesn't, so what? But as an entrepreneur, when I'm the lead entrepreneur, something I want to own 55 to 65% of that project minimum, and I won't go below 55. And usually I'm at 65, so I'm in that range too in the projects where I'm the lead, because I'm interested in that. Because I own 55 or 65% of the business, or maybe 70 if I'm lucky. But it's between 55 and 70% at the end of the day for you, and hopefully it's 65%. And you will have raised by that point probably somewhere between $3 and $5 million by the time you get to 35%. Because we don't have to worry about issue number 2. Right now, what you're doing is you're going to raise $150,000 in equity and $750,000 in debt. That's what you're going to do. And you're giving up 10% of your ownership, and you're offering 8% on the debt. That's a very fair offer to somebody. I'm not sure if Salama will like that offer. you know, she might like the 8% on her money, because if she just puts her money in the bank, she's going to get maybe 1 or 2%. So 8% might be attractive to her, but you're going to have to explain it to her. It's mostly debt, and she gets 8%.
Yes, I think maybe a portion of Solalma can be put in here as a debt.
I would hope so. In my opinion, she owes you a little bit of loyalty. Can you stop sharing your screen just for a minute? So I just want to go back to Petrolia just for a minute, and then I got to get going. So Ruben, is there enough room for another building over here on the side here?
Yes.
Because
one is a one-sided building. Is the only thing is that it has to have fire-rated walls in the back. That's the only thing.
So the one thing that I would do here, I'm going to stop sharing for a second. Give me a sec. Because I just want to show you what I'm thinking. Yes.
This one, yeah. I guess maybe in the next meeting we can sharpen this strategy before I start presenting it to people.
Yeah, but I think you have a better grasp of my approach now than you did before this meeting. I think you've got it. All right, so this is what I'm thinking for Petrolia, and you know, just it's my kind of thought here. So what I'm thinking is that it looks like the setback line is here, right? You can see that, right? So I'm thinking that your next building should be something like this. Okay, does that make sense?
Yes.
And what I'm thinking is that this piece here, depending on what the zoning is, should have, you know, if you did this building as a workshop, I don't really like what I just did. If this little piece up here would have, you know, its front door, so to speak, facing Progress Drive, right? So this part here would make an excellent workshop because it faces Progress Drive, assuming that you can, you know, there's natural gas here, and assuming that the zoning permits it, and you know, you would end up with, I'll just go with the smaller line. So, you know, you'd end up with a man door like this, if you sort of see what I'm doing.
Yes.
And you'd have a garage door here.
Yeah.
All right. And this building here, in my opinion, should be, if you were going to do one workshop building, it would be this building here.
Okay. So
this would be workshops and storage. I'll send you this picture after we finish.
Yeah.
And then, you know, the storage buildings, you know, I'm assuming that you'll do more storage buildings back here. Is that correct?
Yes.
So where would the RV storage go?
I may not be with RV in there. I think that should be
I
on.
think you're right. I think so. This is where your storage would go. More storage would be back here somewhere.
Yeah. Yes.
Okay. So I'm going to just say that then would be storage.
And on the left side will be the drive-through going to the back. But I still have to go there and take some measurements, some actual measurements.
So this would be, yeah. So I think this is the highest and best use for Petrolia. More storage buildings back here and one workshop building.
Yeah.
This I really want you to try it, because if it's successful, you'll do a lot of that. You're still young enough. You and Mary Lou, you're still young enough to do 100 buildings like that.
That's great. I'll like that. Oh, just one last question, and just to ponder, we don't have to answer it right now. How are we going to support the $750,000 debt for the investors? I mean, normally.
Oh, that's a very good question. Okay, hang on a second. I'm just going to save this. I want to save my diagram here, just so I don't lose it. I'm excited about Petrolia.
Yeah,
You have some friends in the construction business who can help you with a workshop building. You've already shown me some buildings that are just perfect for it. These
oh
are,
yeah.
okay, so you could price it out. All right. So one of the things that you know that I've come to realize in the last year is that you have a lot more flexibility if the debt, the $750,000, is simply corporate debt. It's just RMDR offering notes, you know, like it's like a promissory note.
Okay, now
So
this is
don't put it as a mortgage. Gives you a lot more flexibility. I've been doing that on my recent acquisitions, and you know, my balance sheet looks a lot stronger. You know, instead of having, you know, if I buy a building for $1 million, I might have a mortgage on it of $600,000, and I might have $400,000 in corporate debt. But on the land itself, you see it's worth $1 million. It's got a $600,000 mortgage. That impresses the hell out of the mortgage company. So it's just corporate debt.
okay. I want that because if I go through RSP, because one idea was to offer it as an RSP mortgage.
Yeah.
Not as an RSP mortgage, sorry, as an RSP investment, right? So I need to check because a friend just did that. I mean, a friend, he raised about $3 million with RSP money through Olympia without a mortgage,
so I don't think that that's possible. So from what I know, and I'm not an expert in finance, I'm still learning really, but I think all RRSP lending, you know, self-directed, has to be in the form of a mortgage.
Okay.
So I'm quite sure about that, because I've asked people who are expert in this business, can we just do RRSP corporate debt? The answer is no.
Mhm.
So I think it's just, if you want to do an RRSP mortgage, it'll be a second mortgage registered on title. There's nothing wrong with that if that's the way you want to go. But I think for you, raising like Salama will have how much, $1.5 million or something like that in cash. She could loan you the 750 herself, and she just gets RMDR promissory notes.
Well, actually, one of the things that the accountant said, that if we do it through Solalma, because we are shareholders in Solalma, it's only called an intercompany loan. It's not,
you know, that would be perfect as long as she agrees. That would be great, and she could just do the entire loan herself, or RMDR could do that between the two companies. That's fantastic. So give it some thought. But the RRSP mortgages are great, except that they are much more limiting. If you just do it with corporate debt, you'll have tremendous flexibility going forward. Okay.
Okay.
I'll see you soon.
Very good. Okay. Thank you,
Mary Lou, for me.
Okay. Thank you. Maybe you can stop the recording.
I'm going to stop the recording, and I'll put it on YouTube.
Okay. So by email, we'll plan the next meeting in a couple of weeks.
Plan the next meeting. See you soon.
Thank you. Thank you. Bye-bye.